This is the London Fintech Podcast, brought to you by your host, Mike Ballerman, bridging the worlds of suits and t-shirts, of finance and technology, bringing you insights, stories, and inspiration from the golden age of opportunity and innovation happening in London right now.
Hi, this is Mike Ballerman, and this is London Fintech Podcast, episode 69, brought to you in association with Synchron, Archover, and Smart Pension. And I'm delighted to be joined by Dan Kiernan, Research Director at Intelligent Partnership. Intelligent Partnership are a research firm that help financial advisors understand a broader range of investments than they would traditionally recommend. In the UK, financial advice is a regulated activity, and the acronym for those such regulated is IFA, Independent Financial Advisor. Like most sectors of finance, what this is has been changing a lot and is mostly driven by those architects of society, regulators. If the average person gets a little financial advice from newspapers and magazines, if it's anything heavyweight, for example around pensions and such, they pretty much have to turn to a professional advisor. As we've touched on the show before, the whole topic of how fintech relates to these advisors is absolutely fundamental to its broader inclusion in society beyond the metropolitan cognoscenti and inside trackers. The other word that looms large these days is mis-selling, the subject of many a finger-wagging newspaper lead editorial and roughly infinite fines. Don't get me wrong, of course there's mixed selling and of course it should be punished. However, get the bandwagon out and before you know it, everything is on there. Furthermore, it goes really over the top when the criteria for what is mis-selling is defined years after the event. So that's the reality here, and the fear of being struck off by a regulator means it's game over for your career as an IFA. So there's a lot of conservatism around what they feel comfortable with doing. Speaking to some IFAs, for example, a couple of years ago at an Intelligent Partnership conference, it was quite clear that they were petrified of, for example, recommending, say, Zopa rather than RateSetter, or vice versa, in case years later they were fined or banned for having given, quotes, the wrong advice, unquotes. It's a foggy area, and I've been looking for some time for someone who knows this area intimately enough, but can also bridge us to the FS world as we know it. Plenty to talk about, so let's get on with the show. Hi Dan, thanks for joining me today.
Hi Mike, it's great to be here. Obviously we cross paths on the circuit quite a lot, but I'm honoured to finally be on the podcast.
Yes, exactly. So I've forgiven you for the many times you've crossed my path and tripped me up. And we were talking beforehand about, you as a listener to the podcast know that we always have this sort of soft section, which of course is my favourite section, where we talk about anything other than fintech. But you didn't appear to know much about anything other than fintech because you're so dedicated to your work as a research director. And we were talking before about an example of Cormac Leach, who was on last year, and literally we started with, actually I'm a very boring person, I don't do anything. And funnily enough, you had a similar story about Cormac.
Yes, I was at a round table with Cormac, and we were doing the traditional introductions, like who are you and what do you enjoy doing. And as we went round the table, we got to Cormac, who said, I'm Cormac Leach and I really like walking my dog. So that was a classic introduction to Cormac.
And your introduction was that you're into ju-jitsu, which I'm always a bit confused about whether it's dancing or beating people up or the same thing at the same time.
It's a little bit of the same thing at the same time. It's a very popular martial art now. It's growing in popularity. And I must stress I'm a complete novice. But the one advantage it has is unlike, say, kung fu or boxing, where when you spar you have to sort of pull your punches. And when you're sparring in jiu-jitsu, you can go all out pretty much.
So is it full contact fighting then?
It's full contact, but because it's submission wrestling, you're sort of grappling with someone up close. So, the name of the game is to catch them in a headlock or an arm lock or a chokehold.
Sounds like life, really. It's a submission wrestling. Are you going to get life to submit to you, or is life going to get you underneath?
Very much. It's a good metaphor for life. But being able to practice going at sort of 90% of your full effort is really useful. And yeah, it's something I really, really enjoy.
Okay, well, it's rare that people get to turn the tables on me in this podcast, but as you're nearer the door than me and your demonstration there of what an arm lock might look like looks fairly effective, I shall go far easier on you than I was going to. Now, the other thing that I thought I knew was that smoking is bad for your health. Now, I think it is probably bad for your health, but it's been good for your wealth. Ba-bum.
It's been good for my career. So a long time ago, I was a smoker. And I was stuck in a job I really wasn't enjoying, that wasn't in financial services as it happens. Every day I would go out for my smoke break at pretty much the same time in the morning, and I got chatting with someone who worked in the same building but wasn't part of the same organisation, and I would moan to him about how much I hated my job. And eventually he took pity on me and he gave me a job in his team for a company called CAPS, which was Combined Actuarial Performance Services. And that was my start in financial services. I started right at the bottom, which was, answering the phone and data entry and all those kind of things. But yeah, that gave me my start, and over the years I've managed to work my way up.
It's good to talk about these things because people don't really like admitting when they have started from the bottom, but there is great merit in having started from the bottom because you really understand the whole process soup to nuts, rather than swarming in as a management consultant at the top and having no real understanding of the rubber and the road.
It's very, very helpful when you're dealing with people.
Because you've been humble like them.
Yes.
You've entered the data.
My first job, this was a job that could have only happened in 1999 really. My first job was to phone people up and ask them what their email address was and then write that down on a piece of paper so we could use it later. So yeah, that was probably something that could only have ever happened in that particular time.
Brilliant. Well, I thought when you said this could only have happened in 1999, I thought we were going to say you're a Y2K checker because that isn't going to happen again. There'll be a Y3K checker if the world hasn't been blown up in the meantime. So, as you say, you weren't in finance originally, so you weren't enjoying your life. And of course, it's not possible to enjoy your life outside finance. But now you live in a whole world of fascination because you're deeply immersed in the whole world of financial advice and independent financial advice. And actually, you'll have to tell me what dependent financial advice is. I'm sure there's a different word for it. So, as the majority of the listeners are outside of the UK, and even for people like me, I've known about IFAs one way or another for quite a long time, but part of 30 years ago they were responsible for selling quite a lot of the Eurobond fund that I managed, which had excellent performance, so did very well for the investors. So, let's assume that our listener in Kazakhstan doesn't know what an IFA is or doesn't know what they were and how it's changed, all that kind of stuff. Can you give us a bit of context down to IFAs in the past in the UK and kind of how it works?
Yeah, absolutely. So,
in not more than 6 words.
As you said in your introduction, giving financial advice in the UK is a regulated activity and it has been since the early 1980s. We've got somewhere between 20 and 30,000 regulated financial advisors in the UK. And there are two kinds. There's independent financial advisors, IFAs, and there's restricted financial advisors.
Are they called RFAs?
No, we just call them financial advisors confusingly. And if you're restricted, you're not recommending from the whole of market. You're just looking at a small subsector of the products that are available.
In, for example, Barclays?
In, for example, Barclays. It's what used to be years ago known as a tied advisor because you were tied to a particular product provider. So we've got something like 30,000 financial advisors, something like 1,500 different financial advice firms. Really, it's quite a dynamic sector. You might not think it, but they stretch from your sort of small sole trader who's out there sort of doing business all by himself to nationals, big independent firms. They might be a conglomeration of tax advice, accountancy, legal services and financial advice. Big networks that provide some of the services for financial advisors and help them with their marketing, but the advisors themselves retain their independence. And, vertically integrated firms like St James's Place, biggest wealth manager in the UK, that have their own suite of products and the advisors are distribution for those products, but they still retain their independence because they can advise on any products from anywhere else as well.
So that's what the market sector is. That's how it works. And so what have been the big changes from when I was involved in tiny part with IFAs 30 years ago and they were selling my bond fund in Guernsey and all that kind of stuff? What's the sort of big picture?
So really the biggest single change was the Retail Distribution Review, or RDR. That came in 2013. That was really a game changer. The RDR was a piece of regulation designed to make financial advice more transparent, fairer for the consumers, and higher quality.
And this is from the FCA?
This came from the FCA, the Financial Conduct Authority, or the FSA as it was at the time. The biggest change the RDR made was that advisors could no longer be paid by commission payments. So people's perception of advisors, in the UK at least, is that they were little more than salespeople, driven by commission and therefore looking after their own interests rather than their clients' interests. It was an agency problem.
Which, of course, some of them were and some of them weren't.
Some of them were and some of them weren't. There were the good and the bad, of course. But it was decided that this issue needed to be addressed. So post-RDR, post-2013, financial advisors cannot be paid commission by the investment products providers. They can only be paid by the clients, the consumer that they're giving advice to.
I vaguely remember that principle, and I vaguely remember at the time thinking, oh, well, that's screwed their business model, because going back to banking as a whole and merchant banking and corporate finance and things like that, or investment management, by and large, people, I'm not so sure about corporates can have their arm twisted, but people are remarkably reluctant to pay the true value of the advice. If, for example, you want to hire me for half an hour to give you some advice, I'm very happy to, but it's taken me a long time to get that advice, so I'm not going to charge you sort of 10 quid. So I thought that the whole switch of the modality would make it much harder to be an IFA.
That's true. That's exactly what's happened. So what we've had is some good and some bad effects from this regulation. The good is financial advisors are now very highly qualified.
Presumably they have to pass some status exams.
Yes, they have to be at least level 4 qualified, but most of them have higher qualifications than that. Many of them are chartered.
Just pressing pause on this one. Everything has a cost and everything takes time and all that kind of stuff. So let's say tomorrow I hang up my podcasting microphones and decide to go off and become an IFA. I'm going to have to go and sit some exams by the state or its regulatory arm. How long does it take me to get to level 4, and how much does it have to fork out to get there?
It's probably going to take you 3 years and several
Wow.
£1,000s. It could be quicker, it could be slower, of course, but it's something like that. To get to that level, you also need to have some experience. So you need to find a firm that's going to take you under their wing, give you some experience under supervision with their clients.
So it's remarkably hard to be an independent IFA, because I couldn't sit around earning no money for 3 years while I study exams.
Exactly. And it's one of the good effects of the regulation in a way, because you know that you're getting a very professional service from a very highly qualified person now. You also know that the agency problem has been addressed and they're working in your best interest because you're the one who's paying them, not the investment providers.
Okay, so I see that, and like everything in life, no matter how thinly you slice it, it has two sides. The flip side of that is it doesn't matter whether it's Roman Catholicism or how to be an IFA or the statist view of what risk is. You will have been thoroughly indoctrinated in a belief system about, what risk is, what is good, what is bad, how to do investments and all that. And that then, like any belief system, like any Kuhnian paradigm, will mean that anything that's outside the paradigm, anything that's outside your level 4 education, will prove rather problematic.
That's absolutely true. So I think one of the issues Fintech has, trying to get advisors recommending their products, I'm thinking here in particular of peer-to-peer lending, is not that advisors don't understand the investment case. They're not intellectually stupid. They can understand the concept and they can see the benefits. But there are some real structural obstacles that have to be overcome for advisors to recommend something like peer-to-peer, for example. So they need to get their compliance team to approve it.
And just in passing, the compliance team would have to do what? Go and visit Zopa and see whether Zopa's kosher or something?
The compliance team need to understand the amount of research and due diligence that an advisor has done and feel comfortable with the level of research and due diligence. And no one says just how much due diligence that needs to be. The FCA doesn't put that out there. The compliance team would need to understand where peer-to-peer lending fit in with the rest of the assets that they're recommending, where it fits in on the sort of risk metrics that they use, where it fits in with the rest of the portfolio.
And just pressing pause on that one, so it's another subject entirely, but as I'm sure you've noticed and everybody else, the FCA hasn't exactly regulated or authorised, should I say, the major platforms yet after 18 months on the case, and they're not going to in a really big hurry from what I hear. But let's say at some point in the time they actually do that, and let's say I'm an IFA firm, again going back to keep it simple stupid, the FCA is regulating me and saying I can't recommend a shite, basically. Well, that's fair enough, I get that. So I should be able to say, yeah, FCA, you checked out Zopa in far greater depth than I could ever possibly do. You've been on their case for 2 years with all your resources. Surely then it's just good enough, isn't it?
No.
No? Fantastic.
The FCA get a pass on this kind of thing, and there is a famous case that really, if you meet an IFA and want to get their blood up, then you just mention this case, which was Key Data, where the FCA, or FSA as it was then, had lots and lots of information on this and how this particular investment was likely to go wrong, but they didn't do anything about it, and they let IFAs carry on recommending it. Then it all went tits up. Loads of people lost loads of money, and the FCA then went after the advisors who had recommended it. So, it's a bit of a sort of
cause célèbre.
Yeah, Kafkaesque world for advisors sometimes when they're dealing with the FCA.
Well, it relate to, as I say, my feeling just from literally sort of talking to a few people in the coffee break when I was at your gig. And it is also, as you say, well, Kafkaesque is a very good word, isn't it, really?
Yeah, it's labyrinthine, and what the ultimate outcome of it is the advisor has more risks on the downside than the upside. So if you think in terms of his professional risk, his career risk, it's better for him to be conventionally wrong than unconventionally right. So if he starts recommending P2P, even though that might be a great and wonderful thing for his clients, if it goes wrong and he's the only person doing it or one of a minority, he's really going to look like he's in trouble, and FCA and FOS, the Financial Ombudsman Service, who adjudicate on any client complaints, may well come after him. Whereas if he's just recommending the same old boring unit trusts and OICs or whatever, the market could tank and everyone could lose money, but he's not going to be any trouble for that.
Interesting. I think we should just draw stumps now, because we've come to a sort of wonderful conclusion. Go and pick it down in Canary outside the FCA's thing, asking for a bit more joined up government. So this presumably implies that your day job is a bit of a nightmare, because your day job is swimming against the tide and saying, look, I know you've been educated for 4 years and that, equities are okay and government bonds are okay, but actually, really, the P2P ain't that bad and all this kind of stuff.
These obstacles can be overcome, and we do have a precedent, which is tax-efficient investments. So for listeners overseas, the UK government runs 2 big schemes to encourage retail investment into small businesses. That's the Enterprise Investment Scheme, EIS, and Venture Capital Trusts, VCT. And basically, you get some tax breaks for investing in smaller companies. And there are some fund managers who run funds of these different investments that qualify for these schemes. Now, 10 or even 5 years ago, financial advisors were not recommending these schemes. They were seen to be difficult to understand, too high risk. Again, the compliance department and the back office didn't understand where they would fit in with the rest of the portfolio, and they weren't part of the business process. Now, that has changed. The sector has worked very, very hard to educate advisors about these schemes, to help them understand the benefits, to help them understand the risks, to help them understand the circumstances when they should be using them, to help them understand issues like client suitability, and that work is now paying off, and many, many, many advisors are putting millions of pounds into these schemes now.
So is it the case then that, because we're talking about bureaucratic mentality here, that the way of not being flogged to death for outrageously recommending something that wasn't in your official course is, as long as you've got 15 folders on the shelf showing that you spent months of due diligence and visited Zupa 100 times and visited RateSetter 99 times, and you've got whole theses written in there, that is actually, you can then cover your arse in the future, because you can say, look, I wasn't guaranteeing the right outcome, but I did lots of research, I did lots of bureaucracy, there's lots of paper to show.
I'm not sure if it's as extreme as going and making those visits and having quite that, having a thesis on it, but your point is correct. The advisor does need to have an audit trail that shows they have done research. Advisors don't like to just pick one product and sort of be trying to pick winners. They like to pick from a selection of products or a selection of services. So an example of peer-to-peer, they want to be looking at all of the different peer-to-peer platforms. They need to feel like they've been able to make meaningful comparisons between them, which we know is something that's very difficult in the peer-to-peer sector, and therefore they're able to make an informed decision about what's right for their client. If they can do all that and evidence that they've done that, then they feel like they're on safe ground.
So it's probably one of the many reasons why, I don't know what the penetration is, maybe you can tell me, but why most people don't use an IFA. Because certainly anybody who's kind of roughly on the scene isn't going to pay somebody a whole chunk of money to actually not be able to recommend them anything. I mean, Anthony Hilton, the city editor of the Evening Standard, who's got lots of sort of grey hair and been around for quite some time, will often make the point that you can walk into a betting shop and you can stick £1,000 on a horse without the state being involved whatsoever.
Yeah, you don't even have to walk now, you could just use your phone.
That's true.
Yeah, well, that circles around quite nicely to what we were saying before about the impact of the retail distribution review. So it does make advisors better qualified, more transparent and fairer, but it has raised the costs. All of that regulation we're talking about, all of that research and due diligence that advisors are obliged to carry out has a cost, and that cost now has to be borne by the consumer, which means that we now have what is referred to as an advice gap in the UK. So only the rich can afford advice,
Absolutely,
really,
yes.
which is an unfortunate consequence of this regulation. It's one that might be addressed by what's termed robo-advice, which we might talk about in a minute or two. But yes, financial advice is expensive.
So before we move on to possible solutions, and by now I'm very thirsty for a solution rather than getting more depressed by the bureaucratic statist approach to roughly everything at the moment, is there a way of arbitraging all this kind of stuff? So let me say, for example, the example of investment trusts. So, I'm sure the 4 years covers an investment trust and discounts and premiums, and it's listed on the stock exchange, so that must be safe, and yada, yada, yada. So is it the case that if I was an IFA, I would be okay recommending an investment trust? So take an example of non-personal stuff. Pension funds will often say you can only invest in FTSE listed UK shares or something. You can't have other ones, or there's a different limit on it. So this is, of course, the reason why P2PGI and others formed investment trusts, because actually that's a way of arbitraging regulations. Because, finally, they can buy an investment trust. They can't buy to P2P, but they can buy an investment trust. If the investment trust happens to invest in P2P, well, that's their lookout, yada, yada, yada. Does that kind of structural wrapper get around the regulatory issue?
Yes. In short, yes.
So it's the triumph of appearance over content.
Yeah, it's much easier for an IFA to recommend an investment trust for the reasons you described.
And it's diversified, of course, so there's a positive reason.
It's diversified. The other solution that isn't really in the market yet but might work is the aggregators. So people like LendingWell, for example, where it's one portal where you can just go through and invest in lots of different peer-to-peer lenders. That solution as well might work better for advisors.
So thinking about this from the solution space, as I say, I haven't given much thought to this whole IFA thing and just kind of absorbed a little bit tangentially in the periphery of my vision, as it were. I can see how this has contributed to this advice gap, and like much of society now, it's set up quite nicely for the non-tax-paying Davos people who are very busy at the moment, and the rest of us have to try and do things in a different way. So potentially, Fintech might be able to handle some of these things, advice gaps and all that kind of stuff. John Kay was on the show last year talking about precisely this as one of the main things. It's been the most downloaded episode so far, and one of the points I recall that he was making was that although everybody is an individual, by and large, people fit into certain categories. If you're sort of dual income, no kids, and you both got reasonable jobs, that's one thing. And if you've got a couple of kids and mum or dad is at home looking after them, it's another. And if you're sort of boring middle-aged like me with no hair, then another. There's various kind of archetypes, as it were, or simple kind of things without fitting into the are you low, medium, or high risk category. So you mentioned the robo-advice word, which I've sort of by and large been very sniffy about and stayed a little bit away because I think it's just another Uber marketing hype, no pun intended. So solutions in general, maybe robo-advice is the answer. You tell me, Dan, because you're the expert.
Robo-advice might be the answer.
Hang on, just before we go any further, what do you mean by robo-advice?
Well, I, like you, dislike the term robo-advice because
we're both British. Well, actually, you're not. Are you Irish then?
I'm half Irish.
Oh, right, slightly British.
Yeah, slightly British, yeah.
Without getting very un-PC. Or fairly soon, you'll be sort of slightly European.
Yes, yeah. I'm actually in the process of applying for my Irish passport just in case everything goes tits up and I can't go to Europe anymore.
Yeah. Well, I think in the way that politicians don't bother giving speeches these days, or rather they give the whole speeches to the media who then reports what they're about to say. As we are speaking at the moment, Theresa May is talking about how there's a bright global future for Britain. So I'm rather hoping we're going to get the empire back.
Yes, yeah. Well, that seems to be implied in a lot of the rhetoric I hear about.
But I'm not sure that the British can ever claim that Ireland was a great success of the empire, but no. we'll move over that swiftly.
No, it didn't go well there.
No, it didn't go well there.
I, like you, I dislike the term robo-advice, and the reason for that is the robo-advice models that I've seen so far, they just look like automated asset allocation.
It's not advice.
It's not advice, it's asset allocation. And while there is a place for that, it's not the whole picture.
And portfolio rebalancing is all I've kind of seen. I mean, this robo thing is an uber hype. All you've got is a little spreadsheet, as it were, saying, your UK equities are now 37%, sell 1% to get you down to 36%.
Yeah, it's just like a decision-making tree. Now, when you think of financial advice as given by independent financial advisors, the investment piece is actually quite small.
Yes.
So you think about what they do, they have to get to know their client.
Take an example of me. I need pensions, I need some insurance and all that kind of stuff.
Exactly.
Which unit trackers index fund to stick it in is not a difficult thing.
Actually, the investment piece, very easy to do. For most people, just having some passive investments is probably going to be good enough, certainly the cheapest way of doing it. From the advisor's point of view, it's also the area where they have the least control over the outcomes. So they really shouldn't be selling themselves on the investment advice.
Yeah. They shouldn't be suggesting, say, German equities compared to French equities, because who knows?
Yeah, they should be thinking much more holistically, and this is what most of them do, but the man on the street doesn't really realise. It is the things you were just talking about. Helping someone budget, understand their spending patterns, get protection, get insurance, ensure their health, think about the decisions they've got to make at retirement or for estate planning. These are all things that are more complex than simply asset allocation, which is all that Roboadvice is pointing at the moment. Where I think Roboadvice could help is because, as we've discussed, the cost of advice is very high. You could, as a younger person, where you perhaps don't have as much wealth, start using Roboadvice to very cheaply build up your wealth by investing, and then as you have more wealth and your financial decisions become more complicated and harder, that's when you can start to engage with an IFA. So I could see Roboadvice as a sort of stepping stone on the route to actually employing a financial advisor to help you.
We were pinging, or you were pinging, and I was ponging on Twitter following the Monzo podcast just before Christmas, where Tom was talking about his concept of what Monzo might be up to this year, and again differentiating between the wrapping and the content. He's moving into the wrapping of a bank, but his content sounds much more like personal financial management advice, supermarketing, mumble. And you were saying that you thought that was potentially a very interesting thing, which is pretty near this area.
Exactly. So, if you read the advisor trade press, you'll read a lot of articles about the threat of robo-advice. And as I've just said, it's just automated asset allocation. It's not a threat to advisors yet. But what Tom was talking about, this concept of looking at people, if you think at people's spending patterns, just helping them understand that and make better decisions about their spending is the first step for a lot of people and actually managing their finances better, not investing in lots of different weird and wonderful equities. So what Tom was talking about, helping people understand their spending patterns, helping them understand which sort of products to purchase, what sort of insurance.
They're landing in Delhi and they've forgotten to get travel insurance, and the app pings them, look here, do you want to pay a tenner? Other people have found this useful.
Exactly. This whole kind of holistic service, I think that's much closer to what financial advisors are doing than what is currently termed robo-advice. And so, I think something like the Monzo concept, that is a bigger threat to financial advisors. Although, again, it may work as a kind of stepping stone to actually paying for an expert to give you advice on complicated decisions like what to do at retirement or estate planning.
Yes, I was thinking, going back to you saying at the beginning that a lot of IFAs are in vertically integrated conglomerates, with lawyers or accountants and all this kind of stuff. And it was occurring to me that to the extent that Fintech will do more and more for you and me and everybody else, quotes on your phone, unquotes, then the bit that's left is, in a sense, a statist-trained person giving you a response to massively complex statist regulation in the first place, which is, why is it immensely complicated to do pensions, as I mentioned many times before? Why is it immensely complicated? I'm not a complete idiot, I'm mostly an idiot, and I know a little bit about finance, but I don't know the 80,000 pages of regulation.
Yeah.
So on the one hand, the state churns out this massive regulation. On the other hand, you've got regulators, and that's the difficulty. And in a sense, if one, as a Gedanken, as a thought experiment, if one scrapped the whole stuff and just left people in the way that it used to be, that you've saved up for your own retirement, then the thing would go away. But from what you're saying, IFA's next squeeze is not, and I agree with you, is not sort of robo-advice per se, but to the extent that they can actually do the investment bit on the phone, then it's really almost this sort of legal come accounting thing, which is, I can't remember how much I can stick in a VCT or an EIS, or what my allowance is, or what this and that and the other. And it's a bit like companies. Everybody has to have an individual company these days. They're like me, basically individual consultants. And I never understand any of that, and I pay an accountant to take it away, take the problem away, and I send them my spreadsheet, which I keep track of my expenses and revenues, and they turn that into accounting-y type stuff. So that's been an interesting run through the whole scene. I'm certainly very glad that I'm not an IFA. It's very, very challenging, and as I say, my experience directly and indirectly is that by and large people never really appreciate the true cost of the good advice they're getting and don't like writing a check out for 10 grand
Yes.
in advice, even if the advice basically costs on total accounting 15 grand or 20 grand, taking into account the investment of years and years. So we'll move on to what the future holds for Intelligent Partnership and you, Dan, and the interesting things that you're doing. You've mentioned this very challenging education piece. I'm glad you've got a precedent at the EISs and VCTs where it's worked out well in the past, but it would seem a sort of Herculean task getting P2P, to take a sort of simple example, onto the curriculum of 3 years of training to level 4 and all these kind of stuff, and filling folders. But before wrapping up the show, I'd like to thank the listeners as always. I'm very grateful. I won't have the chance to meet all of you individually. Maybe one day I will. I'm meeting you one by one. And I'd also like to thank my friend partners for the podcast, Archover, smart, simple and transparent P2P business lending. Loans up to £3 million for SMEs, delivering up to 7% secured and insured returns to lenders. Smart Pension, who are fast, secure and free. Check out their UK workplace pensions at autoenrolment.co.uk. And Synchron, digital, business consulting and technology services for top-tier FS. From startup to 6,000 people, 16 countries and $400 million of revenue. And right, now I'd like to thank you, Dan, by letting you off the leash. You've survived to this stage by the usual way that everyone survives, which is that everybody knows far more about what we're talking about than I do. So actually, it's always a bit easier than they think, especially when they sort of throw facts into the argument, which always catches me out every time. So what's going on, interestingly, for you, Dan, and Intelligent Partnership in 2017?
Well, we're doing more of the same. We are forever growing our community of advisors who download our reports and attend our events and are interested in the insights we can provide.
So, for example, how many reports a year do you do and how many advisors download them?
We do 12 reports a year, 6 big industry reports. They're 30 or 40,000 pages, words long.
That's a long one.
Yeah, sorry, I got that wrong. They're 30 or 40,000.
Don't worry, I won't edit it out.
30 or 40,000 words, typically 80 pages, seen by 6,000 or 7,000 advisors. So they have a big distribution.
And the advisors pay for them?
The advisors get them for free, which gives us a lot of distribution. And what we do is we invite investment providers to participate in the initiative, and they pay for the costs of production and printing, and in exchange they get a page of editorial in the report. So that's the business model. It's a way for investment providers to get some profile with financial advisors. So we do some of that on fintech areas. We've done reports on peer-to-peer lending and alternative finance in the past. So any peer-to-peer lenders or alternative finance providers or crowdfunders who are listening who want more exposure to advisors, and they should get in touch and we'll see if we can include them in our reports.
And in terms of downloads, from what you say, any listeners to the podcast can go to?
Absolutely, anyone can download the reports.
What is the website?
The website is intelligentpartnership.com. You don't have to pay for them, you just have to register. So yeah, any listeners who are interested, go on there and have a look at the reports. We also do educational events for advisors. So we go all over the country, getting advisors together in a room and talking to them about alternative investments, whether it's the EIS and VCTs that we spoke about in the podcast or peer-to-peer lending or whatever it might be. And we typically do dozens of those events a year. And again, we invite people to participate by coming along and speaking at those events and raising their profile with financial advisors. The final thing I probably should mention is not the Intelligent Partnership, but one of our sister businesses in the same group of companies. It's called In Review. It grew out of reviewing investments for SIP operators.
And SIPs are?
SIP is a self-invested personal pension. They've been around in the UK for a very long time, and the people who run these pensions, they employed In Review to do third-party due diligence on alternative investments. In Review are now also doing third-party due diligence on peer-to-peer lending platforms. So they will write a review, and that review can be downloaded. It now has a much bigger audience, this business, not just SIP operators, but also financial advisors. So thinking about what we spoke about the paper trail that an advisor needs, this would form part of that paper trail if an advisor was going to recommend a P2P platform.
So it's a very good example of where we can all get a bit too tech obsessed and think the answer to everything is an app. but it isn't necessarily. The answer to many things can be to find a firm like yours who does high quality research and has found some way to monetize it, and actually makes that freely available in the way that there's plenty of good information out there on the interweb if only you know where to find it.
Absolutely. Think about it from the financial advisor's point of view. They can go onto our website, they can download a report and read 40,000 words of education on alternative investments, peer-to-peer lending. They can think, okay, that sounds interesting, I want to know more. They can come and attend one of our events and hear from the people in the sector in person. And if they think, well, that's great, I'd like to recommend some of this, but I'm not confident reviewing it all myself, where do I go? They can go to the in-review business and they can get their review and put that in their audit trail, and then they can feel like they've been on this journey and they can recommend a peer-to-peer lending platform feeling very confident that they know what they're doing.
Excellent. I'm rather thinking of that in nature. Quite often when something grows up that's poisonous, the antidote is right next to it. So
yes.
We've kind of come full circle about the challenges of IFAs and how the market has changed in the UK and the real genuine difficulties and burdens imposed upon them, probably from the best will in the world, but it ends up being perverse like most things. And you're talking about some of the solutions in terms of the appy world, but also the just purely happy world, oh dear, of you guys making stuff available. So thanks for that, Dan. Time has flown by, and I wish you every success in the future.
Thank you very much, Mike.
Thanks for listening. If you have consulting, advisory/non-exec, or media needs in the FS or fintech space, get in touch with me at mike@londonfintechpodcast.com.
We could sit in a bender all day, watching the firelight dance, watching the firelight dance. We could walk in the mountains before dawn, watching a happy moon ride, watching a happy moon ride. Come away from the city, but with the tarmac so dead and the people so sad. Come away from the city, but with the faces so grey, with the pain of the everyday. We are wild like the mountains and the trees. Can you see what I mean? Can you see what I mean? We fit in between the earth and the sky. Kiss the city goodbye, wave the city goodbye. Wave the city goodbye. The city goodbye. Watch the firelight dance with me. 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 Watch the firelight dance.